Hi, everyone. We're delighted to have you amongst us for that beautiful session. I have with me today F.Kreitmeier of SwanCap Capital, the Honorable N.Sherry joining us from the island of Tasmania in Australia, and last but not least, D.Weeks of the AMNT in London, and your humble Gallic servant, N.Firzli, joining you from the World Pensions Council here in Paris. So I think today we were tasked to give, I guess, the asset owners slash PE investor perspective from a broad pan-European and global perspective. And I think we have like 45, 50 minutes in total. So first, I'm going to ask quickly, by which I mean really 1 minute max, each and every one of you whose reputation precedes him, but to give us a sense of who he is and what is his organization. And I'll start with the Honorable N.Sherry in Australia. Nick, you have 1 minute.
Thank you, and good day to everyone from down under. I'm the former Australian Pensions Minister. I've had some 33 years in pension policy. Before I was elected to the Australian Senate and was Minister, I actually established 2 pension funds. Since I retired as a Minister 8 years ago, I've been chairing a major global IT admin platform provider to pension funds, insurance. I've been a consultant on some fund mergers, consultant to Ernst & Young and Citibank on pension policy and pensions. So a long history and a deep history in both pension fund policy in Australia, but also individual pension funds and the design of the system. And I've also done a hell of a lot of work internationally, OECD, in Ireland, the UK, the US, New Zealand, obviously Australia. So all aspects of pension systems, their design, operation, and also all aspects of pension funds.
Thank you, Nick. And I think your modesty honors you, but you're also the co-chair of the G7 Pensions Forum and the co-founder and co-chair of the Singapore Economic Forum. But without further ado, now we're moving to Germany, and Florian, the floor is yours.
Thank you very much, Nick. Florian Kreitmeier, dialing in from Munich in Germany. Good morning, everybody. I'm the co-CEO and managing partner of SwanCap. We are a private equity-focused investment boutique based in Munich, New York, Luxembourg, and Milan. We are currently managing some 3 billion of assets in private equity in Europe and North America. And I'd say 85% of our client base is institutional money from Europe and the US. And the remainder comes from larger family offices.
Thank you. And David in London, the floor is yours.
Nick, thank you very much indeed. Welcome everybody to the webinar this morning. As you say, Nick, I represent UK occupational pension schemes, and in particular pension scheme asset owners, the representatives of the employee members of the pension schemes, who, as an aside, are taking an increasingly proprietorial role of their responsibilities compared with the fund managers. In terms of scale, we represent about somewhere between 1/3 and 1/2 of the UK occupational pension sector in assets under management terms, say GBP pounds sterling, just under 1 trillion pounds, slightly over that, obviously, in terms of euro. So we're a major force in the UK pensions, occupational pensions sector, representing the members themselves rather than the professionals who are involved in various aspects of governance, investment policy, and administration.
Thank you, David. And well, some of you know me, but my name is N.Firzli. I'm the Paris-based director of the World Pensions Council, which is an international think tank focusing on pension economics, pension investment, and it's also an international asset owners association, mostly pension funds, and to a lesser extent, endowments and sovereign funds. I'm also the co-founder and co-chair, and it's my honor, of the Singapore Economic Forum with the Honorable N.Sherry. Of course, this year, because of the COVID crisis, we haven't had the chance to travel as much as we did in the pre-COVID era, but we hope that things will come back to normal in the summer. And we're delighted, of course, to have been invited by BII and Skills to co-chair that session today. Without you, I'm going to ask each and every one of the panelists to go through 2 or 3 topics. And the first one is the following. Of course, giving us your own national, social, whatever geographic perspective or biases, it's fine. But in your opinion, why have we witnessed in the past quarters an acceleration of the rise of private equity as an asset class? So why do we see more asset owners, pension funds, endowments, sovereign funds allocating proportionally more to private equity? And do you think that trend will accelerate and amplify in your country and in your part of the world? And perhaps we could start now with D.Weeks in London. David, the floor is yours.
Yeah, thank you very much indeed. May I, in terms, I think you're absolutely right in saying there is a tendency for private equity and venture capital to increase. In terms of what are the factors that are building up towards that, perhaps I could look first at the demand side and secondly at the supply side. In terms of demand side, I think there are several factors that are involved. Number one, search for yields at a time for otherwise very thin yields, and in particular, a facility for investment in vehicles which combine yields with long-term stability. The second thing I think I'd point is one of perception. Private equity is becoming a recognized asset class, which is appealing to pension scheme boards who are inclined in the UK certainly to be cautious in their approach with their long-term needs. I think the fourth thing I'd mention is that private equity can offer asset owners. I mentioned earlier that the boards of trustees were becoming more proprietorial compared with the advisors. Offers them more scope for influencing directly company activity compared with PLCs, and concern for ESG factors figures heavily in that one. And then the next one I'd point for growth is that there's a beginning to be a sort of burgeoning move for the UK government to take an interest in particular sectors. I mentioned ESG, and technology sectors is one which has also attracted the attention of the Prime Minister and his advisors. So I think those are the main demand sides. I just mentioned on the supply side, I think the factors there which point to a greater investment in private equity is first of all simply the complexity of running PLCs and reporting procedures that are increasingly necessary. Directors and shareholders find them increasingly onerous. My own scheme, you used to look in the annual report and you see a report about engineering businesses. Now you find a lot of stuff about corporate affairs.
And for those of us, for those of us who are outside of Britain or the Anglosphere, PLCs would be listed equity, listed companies.
Yes, indeed. Yes, yeah. And finally, I think on the supply side, simply consolidation taking place, as N.Sherry no doubt will tell us in Australia. So I think there are a number of factors on both demand side and supply side which point in the direction you outlined, Nick. There are also factors that hinder these trends, but I'll leave those for a later answer.
Thank you, David. And now perhaps on to N.Sherry in Australia. And of course, Nick, you're speaking today from a country which on average, if you look at Australian pension funds called superannuation funds, I think on average, you guys, compared to the OECD or Western world average, you tend to invest 4 or 5 times more than your European peers in non-listed. So 3, 4, 5 times more in non-listed assets. And that applies also to venture capital and private equity. Australian pension funds tend to invest on average 4 or 5 times more than their European peers in VC and PE. So tell us why, and also tell us if you see the trend continuing going forward.
Yeah, great, Nick. I think there's a couple of characteristics about Australia that have helped drive that growth in private equity, infrastructure. Firstly, the sheer size of the system. Australia has the 4th largest pension system in the world for a country of 26 million people. We're trying to beat Canada in terms of the total size of the system, about $3.5 trillion US. As a percentage of gross domestic product, we're about 170% of gross domestic product. So it's a very large system. It's the other interesting aspect, and it's significantly different from, say, Germany, the UK, or the US. We're overwhelmingly a defined contribution system. So there's a really significant focus on long-term returns after fees and charges in a defined contribution system. And that and our trustee governance, we have a trustee governance system which requires trustees to maximise the return in a defined contribution system. There's no fallback as you've got in a defined benefit, where the employer ultimately, regardless of performance, has to meet the promise. So they're sort of macro characteristics. And I think the other interesting characteristic is we have now in Australia some very, very large funds that are globalising. Some names which people may be familiar with: Australian Super, CBUS, Host Plus, Aware Super. There's a massive aggregation. So we have gone from about 3,000 funds 20 years ago down to about 150. And just today, another major fund merger. So a fund in Australia, a medium-sized fund, is at least $10 billion Australian. And scale gives you an advantage. Scale gives you increased resources, capacity, sophistication to make decisions around PE and infrastructure. The majority of the Australian equities market is owned by the pension funds. But interestingly, globalising, because we're a touch over 170% of GDP, the funds are now sending their increased savings offshore. So they've been the fundamental drivers. And the other interesting, all the evidence would show in Australia, and we have very good data, funds have to report where they're investing, what their returns are, categories of investment. The evidence would indicate that, particularly in a defined contribution system, bonds and cash is not the place to be. Australia, like the US, is predominantly equities, alternatives, infrastructure. It's return. they're the fundamental drivers of the shift, and it will keep increasing, in my view, and it will keep internationalising. I mean, frankly, given that the Australian pension funds dominate our equities market and the system's growing, it'll be 5 trillion Australian dollars. It will go up from 3 to 5 trillion in the next 10 years and get close to 200% of GDP.
Right. Thank you, Nick. And I want to say that you touched on very important points. One of them is, of course, the average allocation and the way it's split between different asset classes. And I think in Australia and Canada, which would be really considered, two of the most sophisticated pension superpowers, as we call them. In Canada, Australia, on average, these pension funds, they tend to allocate 25, 30, 35, or 40% to non-listed assets, which is a lot. And in that 35, 40% block allocated to non-listed assets, private equity and venture capital typically represents 8, 9, 10% of their overall allocation. Compared to the EU average or to the OECD average, pension funds in Europe, in mainland Europe, they tend to allocate 7 or 8% only to non-listed assets. And so part of that, half or a third, would be private equity. So it's really a completely different ballgame. And of course, because listed bonds, government bonds, have been yielding mediocrely or negatively in the past 6-7 years, guess what? The annualized return of your average mainland European pension fund or retirement scheme in the past 4 or 5 years has been mediocre or close to zero, compared to 9, 10, 11, 12% per annum in Toronto, Montreal, Sydney, Melbourne. So that also explains the widening gap in AUM. But without further ado, and I want to say that when I criticize Europe, I'm doing it from a European perspective. I'm a proud European myself, so I'm a Europhile. But and also when I criticize, for example, let's say Germany, I have to reckon that we, the French, are actually behind the Germans. So my critique is always, positive and well-intentioned. But without further ado, we'll move to Bavaria, and I'll hand the floor to Florian.
Yeah, thank you, Nick. I mean, with regards to that spectrum of percentages being allocated to alternatives and or private equity in particular, Germany for sure is at the low end. We've seen more and more capital from the institutional world, the German institutional world, moving into alternatives and private equity as part of that, next to infrastructure, real estate, etc. And, most factors have been mentioned already, not much to add. Clearly, in a low, we call it low to no interest environment, which is going to stay there, for longer, our belief. Pension plans have to act and move somewhere else where they can get some yield. And, so yes, foremost, it's a search for yield as the main factor. But next to that, it also, I think, it's a rational move in terms of portfolio construction. When you think about it, you're building those portfolios 5 billion, 10 billions and above. And, the alternative part, as you mentioned, we look into Canada and or Australia and, look at the pie charts and the performance and obviously the correlation in between. So it also comes down to portfolio construction and performance. And, the crisis has shown again, the resilience of private equity during such a difficult environment. You go back 20 years, look through the cycles, the performance, outperforming public equities and other asset classes. So, it's yield, yes, and where do you find such yield in a very sort of more resilient way? It's in private equity and other alternative asset classes. So, we would expect, more and more capital to go into that category.
Right. And, I want to make just a quick biographical remark. I think before joining Swan Capital, you worked for one of the very big British, right, private equity firms, which I think was founded by the disciples of Georges Doriot. So what I want to say is that we Europeans tend to have an inferiority complex vis-a-vis, the Americans and the British when it comes to venture capital and private equity. But many of these notions were actually invented back in the 1950s and 60s by European expats. But these guys left Germany and France, and they went to Boston and New York, and they invented modern venture capital. And the reason why they left Europe, because there was no place for them in Europe. But these ideas, so the financial economics and management ideas behind very fashionable, trendy notions like PE and VC and private assets were actually, to a large extent, invented by Europeans. It's just we forgot about them. And now we're simply rediscovering them in a way. And I want to say that, last week, sadly, another disciple of General Doriot passed away. He was the former president of INSEAD in Fontainebleau. And so we have in Germany and France excellent business schools, and so we're well prepared. And I'm saying this to our Anglo-Saxon fellow panelists in London and Tasmania. We are mainland Europeans prepared to rise up to the challenge in the field of private equity and venture capital. But the
challenge is, Nick, you didn't implement it. And we didn't get this influx of French and German visionaries.
The idea, man. The idea, people.
Our delivery and implementation is Australian homegrown.
You guys are the doers, we are the voyeurs. But let's move to the next issue, which is basically the COVID crisis, right? So one of the reasons why we're meeting today using digital infrastructure, which by the way was funded to a large extent by private equity funds and firms, we're using digital infrastructure because of the COVID crisis, the lingering COVID crisis, and apart from perhaps Singapore, Israel, Britain, most of the world still is in the middle of that COVID pandemic, and we won't be able to go back to normal before 5 or 6 more months. And so policymakers now, the world over, I guess in Berlin, Paris, London, they all want, to jumpstart the economic growth engine, right? Because last year we had, minus 15% GDP growth. The first quarter was mediocre. So policymakers are obsessed with the notion of, jumpstarting the economic growth engine, and they look around them because there isn't enough money, I guess, in the coffers of the state, and they can't print enough money. So they look around them, where is the capital? Where is that long-term capital that we could harness to jumpstart the economic growth engine? And say, oh my God, we have these huge pension funds in Britain, Holland, Australia, Canada. Let's harness their long-term capital. And of course, private equity and venture capital investment create jobs, and they perhaps create jobs more than listed equity. And they very often create localized jobs in a particular region or lender or nation. So they're also very good for job creation, and they're very good for, economic growth. And so they're turning now, policymakers, they're turning more and more to asset owners and asset managers, and telling them, great, we love you guys. Why don't you come and invest more in these creative enterprises in London or Edinburgh or Dusseldorf, etc. And sometimes there is schizophrenia from the part of policymakers, because these same policymakers are the ones penalizing pension funds and insurance companies with these silly Basel and solvency regulations. And so the same policymakers who want pension funds to invest more in private equity are the ones imposing on them these harsh regulations, which actually incentivize pension funds and insurance companies to invest more in government bonds and less in private equity. So there's really a schizophrenia at the heart of the discourse. And I'm saying this, of course, with all due respect for policymakers, and I'm saying this as a wink to the Honorable N.Sherry, but basically, in each and every one of your countries, in Germany, in Britain, in Australia, if you guys had a magic wand and could spend 2 hours with the Prime Minister or the Chancellor, what would you tell him or her to make it happen, to really unleash the trillions of pent-up assets that are dormant in government bonds, listed equity, and to allow them to move towards, more VC, more PE investment? And that would include, of course, insurance companies, endowments, and pension funds. And perhaps we can start in Germany with Florian, what would you tell the Chancellor?
Well, I'm very interested to hear actually Nick and David on that topic. I mean, I think, you know, when you think about Germany in a way, you know, you would need to take a step back, and it's also about communicating. And Nick, you mentioned, you know, what private equity contributes to an economy and to a society as a whole. That's a bit underestimated and not very well documented. You know, David said the asset class as such has become more like a established investment space, but still, you know, it's a bit of an unknown to many, and not 100% clear, you know, how much of that growth of those jobs out there, of tax payments, etc., is generated directly or indirectly by private equity. So first, you would need to educate actually and come with in a transparent way, you know, to show the contribution of private equity. And you know, it's not to be underestimated. State stimulus is great, but private equity can play a major role. And it's not only funds and capital, but it's also resources. You know, think about, you know, transformation, digital transformation of processes, not only processes, but, you know, business models and outside the business world of private lives, administration, healthcare, you name it. You know, there's so much innovation. And so you can nail it on innovation, you know, resources from private equity to help to innovate and to finance such innovation, you know, and start off with showing how much contribution that could be. I think, you know, that would create openness, you know, to change the legal framework. It has started. The Institution Award in Germany has more leeway to invest in alternatives, you know, not enough yet, but more, you know, it's opening up in a way, and people look into the Nordics where you have such huge funds, AP6, AP7, etc. So, you know, we're on the right way, but it's still a bit opaque to many policymakers. You know, how exactly could that work? And then ultimately, you would also need to make the overall legal framework more attractive for private equity to come to your country, you know, to settle and to invest.
Right. And now on to London, and before moving to London, I would like to say that that, you know, you guys, you know, in the post-COVID, post-Brexit era, I guess, you guys, the Brits, are one of the only two pension superpowers in Europe, the other one being Holland. But basically, apart from, you know, Britain and Holland, and to a lesser extent, Scandinavia, you know, most pension funds, most pension industries in European countries are really small compared to these giants. And one thing England or Britain has for her, not only is the size of the City of London and the size of the UK pension industry, but there's a secret weapon that the Brits have. They have the closest thing that Europe has to the Silicon Valley. It's not there yet, but you guys have London Tech City. And even though it's not as big as the San Francisco Bay, in the field of private equity and venture capital, London Tech City in the center east of London is the biggest private equity and venture capital investment hub we have in Europe. And perhaps it's not a coincidence that Britain also has the biggest pension industry in Europe. And what I'm coming at is probably there is a virtuous circle. If you have a lot of long-term creative capital, that helps you build a strong national private equity investment industry. The two are intimately linked, or are they? Shall I ask David Weeks rhetorically? David, the floor is yours.
Thank you, Nick. I think I'd like to look first of all at the long-term, or some long-term factors that are involved, and then some short-term that are involved. In terms of the long-term, I think the view you just expressed, Nick, was very well expressed in a magazine we have called the Investor Magazine, who ran an article last month heading "Shooting for the Moon." And what they said was this: with economies in free fall and the future uncertain, investing in high concept, high risk ideas or companies with the potential to change the world suddenly become more appealing. And that's the positive case for it. Against that, my political career, as you know, extends back to the days of Mrs. Thatcher. And I think back to what Mrs. Thatcher thought of private investment. And her view was that not to look so much at the opportunities, but more at the risks that are involved. And she saw potential investment like this as a means of pork barreling loss-making industries and promoting special interests which ought to be subjected to the forces of the market. So I think there is a definite shift. So if you go back to your original question, what would I say to our Prime Minister, Mr. Johnson? I would say, I think you need to take a view on whether you are a Thatcherite and still retain the view of the problems involved, or whether you're going to look more firmly to the opportunities which the Investor magazine puts forward. In terms of short-term factors, I think there are some short-term factors, and the main one here in the UK is that private equity is simply seen as having a bit of a dodgy past. You know, there's the dot-com boom of 20 years ago that still has some sort of resonance. And more recently, as Nick will know, there's problems with a concern of corruption with our former Prime Minister David Cameron on private equity type investment. So there are some long-term issues that Mr. Johnson will need to address, and as to whether he's a Thatcherite or a post-Thatcherite, and there's some short-term issues which he'll need to grapple, which is the sort of slightly murky reputation. In terms of pension schemes trustees, as opposed to the national policy makers, I think their main concern is simply are the databases for analysing the results of private equity, are they good enough, and do we as trustees, directors, have the capacity to analyse them correctly? And there is an issue there which needs to be addressed. So I think those will be the factors that Mr. Johnson, in my view, should take account of. Whether Mr. Johnson, who tends to be a bit of a willful character, will listen to what I have to say, you may have a better view at an objective level than I do.
Thank you, David. And before we move to the Honourable N.Sherry, just a quick comment. So to use a French or Latin word, a caveat or nuance. So everything you say is true. The nuance I would make is that I would distinguish, even within venture capital, between what you described as the shot to the moon, or the very edgy, risky, ultra deep tech or high tech ventures, and the more mainstream traditional private equity, which tends to be, even though it could be a little bit more risky than listed stocks, tend to be still quite low risk. And if you look at the data, private equity investment, even in technology or telecom or biotech, aren't that more risky than listed ones, as long as the proper, of course, management mechanism are in place. And I'm excluding these exotic shot to the moon .coms that you described. And I think because of a few bad apples, because of a few .com bad apples, sometimes the media tends to conflate and exaggerate. Something else I would say is Thatcher was a creature of the late 70s, early 80s, of the Milton Friedman Chicago school, and it's not all bad. She's right. Pork barrel subsidies are bad. So she has a point. But I think private equity firms and pension funds don't necessarily want from Brussels or Berlin or London subsidies or pork barrel friendly money from the government. What they would like to see more is, I think, fiscal incentives to start with, and also regulatory incentives. And for the governments in Brussels, Berlin, and London to make these small regulatory or legal adjustments regarding the implementation of Basel and solvency, which are shackling asset owners, wouldn't cost them a lot of money, but I think it would help really release tens of billions of dollars or euros or pounds into productive capital, into private equity, and create jobs across Europe and the world. And now we're moving to Australia. Nick, tell us what's happening in Australia. You guys are more advanced than us, but is there also in Australia for the post-COVID era a demand for these regulatory loosenings or subsidies from the government?
A couple of quick points, Nick. Firstly, I should mention the Swiss system, not just because Florian's on our panel. The Swiss do pretty well too. If you look at their percentage of GDP, etc., in Europe, you know, they're in the top 4 or 5 in terms of their system. Look, I'll just make a couple of quick observations. Firstly, in a capitalist market economy, there will always be firms that you invest in that fail for whatever reason. I mean, that's the nature of capitalism. So it's important from a pension perspective, one, to diversify. You've got to have diversified investments. And within that diversification, the Australian experience is very good returns. All the evidence would show good returns. And there will have been a failure or two. And they, as you say, in today's world, particularly tend to get the critical media. But at the end of the day, it's the aggregate diversified return in a capitalist market economy that is the key. Secondly, and we took this from the UK, we're a trustee-based system where trustees make the decision. Government does not direct. And I'm come from a left of centre party, and we've learnt that government should not be directing pension funds into a particular bridge or road or IT, etc. You do need that arm's length governance and let them make the decisions, because I know from my political career, you're always going to get and some of these are friends or former friends who want to build their favourite bridge or investment in their favourite agriculture or whatever. There is a role for government in the sense of providing some limited, and I do stress limited in terms of scope and time incentives in particular sectors. So if you're wanting to encourage investment in solar energy, for example, or wind power, we have particular programs in Australia that have encouraged investment in those sectors, but I'm certainly not one who believes that those regulatory and fiscal incentives should remain forever. And we're going through a debate about electric cars at the moment. Right. How do you encourage investment in electric cars? That, I think, is the role for government. The other role for government, of course, is I really worry about low interest rates and the asset bubbles that we're seeing emerging in real estate. And I worry about interest rates are the lowest since the pyramids were built about, 4,000 years ago. It's quite extraordinary. And I think there will be an adjustment at some point in time on asset pricing. So, but, governments are using low interest rates, obviously, in the COVID environment, as they did in the global financial crisis. And I understand why, but they should only be temporary. And unfortunately, governments have a bad habit of not taking hard decisions around fiscal and intergenerational issues, and over relying at the moment on low interest rates, and it can't continue.
I'm reminded that we just have, unfortunately, 2 minutes left, so I'll ask you the closing question, and of course Florian and David can throw in their wisdom at the very end. We just have 2 minutes left. So now we're seeing an acceleration of the Chinese-American or Sino-American race, and it's really accelerating in the past few days to the point that now potentially large pension funds from Canada and Australia and large private equity investors could be caught in the crossfire between Beijing and Washington, which may soon become a crossfire between Shanghai, Hong Kong, and Wall Street. So do you, notably when it comes to technology, private equity, including infrastructure tech, do you see that happening, that you know, we in Europe and Australia may be caught in the crossfire?
Well, look, I think Australia's been caught to some extent. I'm a great admirer of China and its growth and what it's accomplished from an economic and social perspective on behalf of its people. But I don't see the world in a simple sort of US versus China. Look at Southeast Asia, look at Indonesia, Vietnam, the Philippines, look at Europe, look at some areas in Latin America. I think we're wrong to look through a perspective of China versus the US. The economic opportunities and growth in other parts of the world are just as exciting. India.
I think we run out of time. So I want to thank that great panel. I want to thank once again Florian in Munich, David in London, the Honorable N.Sherry in Tasmania, and I think it was a very dense topic. So hopefully BII and Skill can invite us at the end of the year in 5 or 6 months for their next private equity venture capital gathering, so we can continue and deepen that conversation. I want to thank Thomas Jesch once again and Laurent Tison for having invited us today. And I wish you all a great conference. Merci beaucoup and à bientôt.
Thank you very much.
Thank you.
Thank you very much.